to share 4 of the 7 points today on financial IQ number 4, which is leveraging our money. Point number 1, these are summaries. Point number 1 is there are many types of leverage. Point number 2, most investors invest in paper assets. These are assets that we have very little control of. Point number 3, an increase in return does not mean an increase in risk. Point number 4, most financial advisors, they are not investors. So to go deeper on point number 1, which is there are many types of leverage. So financial leverage most people are familiar with is the leverage of debt. The leverage of debt, also known as OPM, or other people's money. Second, there are other types of financial leverage, which include the leverage of financial intelligence applied to financial control. This is the keyword, control. There are 5 forms or types of financial intelligence. These are increase in income, that is, and financial intelligence. Protecting our money from predators is another form of financial intelligence. Budgeting our money, leveraging our money, and information about money. So these are financial intelligence. 4th point, leverage. What is leverage? Leverage is anything that makes your work, my job, easy, a little bit easy. An example, if we have a box that we need to move, it is very easy to move this when we have a machine called forklift to lift this up. That is an example of leverage. Having higher financial IQ, it is easy to make sophisticated investment decisions. So the leverage is having a higher financial IQ. When we have higher financial IQ, then it is easy for us to make sophisticated investment decisions. Point number 2, most investors invest in paper assets, assets that they have little control over. First point, examples of paper assets are savings, stocks, bonds, CD, mutual funds, index funds. Second point, because these assets allow little to no control, these investors have little leverage, have low returns on investment, have low financial IQ. Why does Robert Kiyosaki say it's low financial IQ? So he gave an example. Let's say, if we put our money on a CD today, at today's rate, you could earn 5%. Specifically, it's 4.6% for a 14-month CD. You lock it in, you cannot get it out. Otherwise, you get penalized. So 14 months, you get 4.6. You may say, hey, Ria, that's really high compared to last year, which was only earning 1% last year. So let's take a look why this is low financial IQ. If you put your money into a CD, that gives you a 5% interest. Now, don't forget, when we earn money from the bank, it's called interest income. Okay, so that means our interest income is being taxed. It's not tax-free. We are being taxed on it, on earned or ordinary income. So if your tax bracket is 37%, that is how much you pay on the interest income. Now, we are on high inflation today, and having high inflation will wipe out the value of our money. So, to dig further, today, the government reports that they were able to successfully reduce the reported inflation from 9% to 7%. It went down by 2 points. And how did they do that? They increase our interest, the borrowing money, they increase our interest when we borrow money, right? So that's how they lowered our inflation from 9 to 7%. So according to them, they lowered it by 2 points. That is the reported inflation. Now, if you listen to billionaires, they say the inflation is even in two-digit numbers. It's higher than the reported inflation. So just say, for this example, it's 7%. To make math simple, it's 7% inflation. And we earn on our CD an interest income of 5%. Okay, that's locked in for 1 year and 2 months. So 7, which is the inflation, minus 5%, we are now negative 2%. Okay, we are negative 2, and that's why the books say if we have low financial IQ, if we put our money into paper assets, because it only gives us 5% return. Now, don't forget, this is not considering the tax. This minus 2 is only being subtracted by the inflation. Now, because it's an earned income, we earned money, we got interest from our money, we are being taxed on it. It's called earned or ordinary tax. So this negative 2 means it's even more negative. It could be negative 3, negative 4, negative 5, depending on our own particular tax bracket. And that is why he said, putting our money into paper assets, we have low financial IQ. And this is exactly why. Point number 3, an increase in return does not mean an increase in risk. 1, when financial advisors say an increase in your return means an increase in risk, Robert says they are correct. Financial advisors are correct only when they speak of paper assets. Paper assets have high return when you have higher risk. Why? Because you have no or little control. Now, these financial advisors are wrong when they speak of all other assets. For example, the business and the real estate. Second point, assets like business and real estate, they require more financial IQ, which allows more financial control. So when we have higher financial IQ, we have more financial control. Okay, this is what the equation means. Increase our financial IQ, we have more financial control. So we permit a higher degree of leverage with very low risk. Now, the key to having low risk, okay, the key to having low risk is higher financial IQ. Don't forget, having a higher financial IQ is another form of leverage. It's a form of leverage. Having higher IQ. This is the key to everything, higher financial IQ. Fourth point, this is why Robert recommends that people should start small. Stay small as we allow our financial IQ to increase. We need to allow our financial IQ to increase. When we have high financial IQ, that means we have very low risk. Fifth point, with increase in financial IQ, our returns on investments would also go up. Sixth point, if financial IQ is low, then leverage may deliver a blow to financial IQ. The financial IQ is measured on return on investments. So if financial IQ is low, then we'll have an interest rate of 5% interest on our CD. So that means it's going to have a return that is low or even negative in the example I provided earlier. Point number 4, most financial advisors are not investors. Financial advisors are salespeople, and most of them invest only in paper assets. Paper assets, again, are savings, CD, stocks, bonds, mutual funds, and index funds. In many cases, their professional and financial leverage ratio are 1:1. So what does 1:1 professional ratio mean? They get paid for their work and only their work, a day's pay for a day's work. So they're trading their time for money. Fourth point, as a business owner, Robert has thousands, okay? That's not 1,000, thousands of people working for him to assist him. So an example of this is his 300 apartment units. That means Robert has 300 tenants helping him pay for his investment. Not only that, the bank lends Robert $4 for every $1. So if Robert has 20,000, the bank would give him 100,000 of money, right? So this is Robert and this is the bank. This is a form of leverage. This is OPM. So this is what it means. The bank will give you $4 when you have $1. Now, Robert also has, so this could be 80 to 100,000 leverage. Now the government, don't forget the government, the tax department gives Robert tax break on his income. Why? Because the government, Robert is doing what the government wants him to do. He's being incentivized to provide housing to solve the housing needs of the community. So Robert pays less in taxes. So these are the example of different types of leverage. So stay tuned for more. I will be discussing point 5 to point 7 on the next show. Alcan Media Show.